Hello students, welcome to this video lecture on funding. Funding is the most important part in any business, and social entrepreneurship also needs funding to run their enterprise and to create an impact in the society. So let us see or let us discuss in this video lecture how these social enterprises are generating funds or the strategies that can be followed to generate funds. Yes, funding. Funding a social venture is a critical aspect of ensuring its sustainability, growth, and impact. Unlike traditional for profit businesses that primarily seek financial returns, social ventures aim to achieve dual objectives. One is financial viability and social or environmental impact. This dual focus means that social ventures require innovative and flexible funding models that align with their mission driven goals while enabling long term operations. Next one is grants and philanthropic funding. Many types are there. This is one type. Grants from foundations, NGOs, development agencies, trusts, and governments are one of the most common sources of funding for social ventures, especially in the early stage, beginning stage. So, what is the advantage? You need not repay that, non repayable funds, and mission aligned support for social impact. Only those who are interested in your service they will fund you. So, they will have interest in your activity, enterprise. So, what are the challenges? It is highly competitive and limited availability, and very many people will be applying for few uh, grant, often time bound or project specific, heavy documentation and reporting requirements. Example: a social venture focused on child nutrition may receive a grant from UNICEF or a health focused foundation to run community nutrition programs. Next one is impact investors. Impact investing is the provision of capital to social ventures with the expectation of both financial returns and measurable social environmental impact. So these people, they have interest in your project, they will invest, they'll give you money. They are interested in both financial returns also they expect, at the same time they want to create an impact in the society also. So who are these people? Social impact funds, development in finance institutions, ethical banks, high net worth individuals, they are interested in funding your project. So, what do they expect? A strong business model, a clear impact matrix, example, lives improved, carbon reduced, and a path to financial sustainability. Example, Acumen Fund and Omidia Network investing in a clean energy startup serving off-grid rural communities. Okay, both the companies are investment firms only. Crowdfunding, next one is social ventures increasingly use crowdfunding platforms to raise small amounts of money from larger number of people, often leveraging emotional storytelling and social media. They empathize with the people. Types: donation based, so need not pay, no return is expected. Reward based, contributors receive a product, a service. Equity based, contributors receive a share in the venture. So, what are the popular platforms? Keto, GoFundMe, Kickstarter, MyLab, Indiegogo. Example: a social entrepreneur raising funds to build mobile health clinics for remote villages via a campaign that tells the story of a healthcare inequities. Next one is earned income, self-generated revenue. Some social ventures generate their own revenue by selling goods or services, often through hybrid business model where profits support the mission. Benefits: greater independence, they need not depend on anybody else. Financial sustainability, because they are earning money in some other business and they are using the profit to fund this cause. Key consideration: ensuring mission and business goals stay aligned. Example: a venture that provides employment to women artisans by selling their handmade products both online and in urban retail spaces. Government support and subsidies. Many governments support social enterprises through seed funding, subsidies, tax exemptions, or public-private partnerships. Forms: direct financial support, access to low-cost infrastructure or land, participation in social innovation, incubators. So all these facilities are available. Example: a government partnering with a social venture to provide digital literacy training in underserved rural schools. Next one is corporate social responsibility (CSR) funds. Companies often support social ventures through CSR partnerships. Under CSR mandates, especially in countries like India, businesses must allocate a 2%, I think, a portion of profits to socially beneficial initiatives. Opportunities: so we will have a long-term partnership. We will have access to corporate expertise and networks. So what are their expectations? Impact: transparency, alignment with corporate values and focus areas. Example: a tech company funding a venture that teaches coding and STEM education to underprivileged children. Social venture capital. Social venture capitalists function like regular VCs but focus on startups with social impact missions. They provide funding, mentorship, and strategic support. They look for scalable models. You should be able to expand your business. Measurable social impact, quantification, strong leadership teams. Example: Eleva Equity investing in fintech platforms that offer credit access to micro entrepreneurs in developing regions. Blended finance. This approach combines philanthropic funds, public sector investment, and private capital to reduce risks and attract more funding into socially impactful areas. Used when the social venture operates in a high risk or low return sector. There is a need to de-risk investments to attract private investors. Example: a clean energy venture using grants to cover our research and development costs, and impact investment for scaling solar panel distribution. How they are distributing their funds, utilizing the funds. Social bonds and pay for success models. Social impact bonds (SIBs) and development impact bonds (DIBs) allow social ventures to secure funding upfront with repayment, often with interest, only if pre-agreed social outcomes are met. This model shifts the risk from governments to investors. Example: a social venture reducing school dropout rates in a city, funded by a social bond repaid by the government, only if dropout rates fall below a certain percentage. Next one is incubators and accelerators. These platforms provide seed funding, mentoring, workspace, and networking opportunities to early stage social ventures. Impact focused accelerators: Will Grow, Ashoka, Unlimited India, Echoing Green, GSBI. So these companies are impact focused accelerators. Some also offer non dilutive capital and connect ventures to larger funding networks. Example: an early stage agri-tech venture joining an accelerator program to refine its business model, access seed capital, and connect with impact investors. Conclusion: funding a social venture requires a blended, strategic, and mission aligned approach. Social entrepreneurs must understand the diverse funding avenues available to them and craft a one funding strategy that ensures financial resilience while upholding their social purpose. From traditional grants to impact investments and earned income, the goal is to sustain operations and scale impact without compromising the values and vision that define the social enterprise. Next, we will see the challenges in funding social ventures. Funding social ventures comes with a unique set of challenges, primarily because these enterprises aim to balance financial sustainability with social impact, often in underserved or low income markets. One of the biggest obstacles is the limited availability of unrestricted funds. Most grants or donations are tied to specific projects, leaving little flexibility for operational costs or innovation. Another challenge lies in attracting impact investors who often seek both measurable social outcomes and return on investment, which is difficult to guarantee in uncertain or high risk social environments. Social ventures also face pressure to demonstrate their impact through data and metrics, which requires robust monitoring systems that can be costly but at the same time consuming to develop also. Moreover, there is the risk of mission drift, where ventures may prioritize revenue generating activities at the expense of their core social mission to satisfy funders or stay afloat. They will deviate from their real cause. Navigating regulatory complexities, especially when combining non-profit and for-profit structures, can also be a hurdle. In addition, many social entrepreneurs lack access to financial literacy, networks, or mentorship, especially in early stages, making it harder to pitch to investors or scale effectively. These challenges require a strategic, diversified, and mission aligned funding approach, along with resilience and adaptability. Next one is establishing the capital needs of a social enterprise. So, how much fund we need? We need to have an idea about that. Determining the capital needs of a social enterprise is a crucial step in building a financially sustainable and impact driven organization. How much money we need to run the organization? That is the basic question. This process involves carefully analyzing how much funding is required to launch, operate, and scale the venture while fulfilling its social mission. The first step is to outline the enterprise's business model and understand the costs associated with product or service development, infrastructure, staffing, operations, outreach, and monitoring of social impact. These costs are typically divided into startup capital, used for initial expenses such as equipment, licenses, and pilot programs, and working capital, needed to manage day to day operations like salaries, utilities, procurement, and logistics. In addition, social enterprises must consider growth capital, which supports expansion into new markets, scaling programs, or increasing production capacity. So, a well thought out financial projection over at least 3 to 5 years is essential, outlining expected revenue streams, if any, potential funding gaps, and timelines for achieving break even or sustainability. To have an idea about finance funding, we need to have a projection. Okay, last 3 to 5 years projection. If we have, we will be able to get a form an idea. Special attention must be paid to the unique nature of social enterprises, which often operate in low resource settings or underserved markets where profit margins are slim or delayed. Furthermore, social entrepreneurs must account for impact measurement costs, legal complaints, and contingency buffers for unforeseen challenges. Accurately assessing capital needs ensures the venture can attract the right mix of funding, grants, impact investments, loans, and revenue, and helps build credibility with stakeholders who seek both financial discipline and social results. So, we can ask certain questions regarding funding. Questions to direct a social entrepreneur toward suitable capital resources, right? So, what stage is my social venture in? Whether it is in the idea stage or pilot stage, early stage, growth stage, or scaling. So, we should have an answer for that. What is the total amount of capital needed now? How much money I need? Startup capital, working capital, or expansion capital? Do I need one-time funding or continuous funding support? Okay. Am I seeking debt, equity, grants, or a blended form of finance? So, what do I want, whether it is debt, equity, or grants? What is my expected timeline for becoming financially sustainable or breaking even? Do I here have a clear revenue model, or will the venture rely heavily on donations or grants? What type of impact am I creating, or can I measure it effectively? Which types of funders align best with my mission and values? Impact investors, philanthropists, CSR departments, government, etc. So, which person you would like to work with? I'm willing to give up some control or ownership in exchange for funding. Are you ready for that? What collateral or guarantees can I offer for loans or credit class? So these questions not only help clarify the type and amount of capital needed, but also guide the entrepreneurs to funders whose goals, timelines, and expectations align with the venture's mission, scale, and impact strategy. Understanding and monetizing triple bottom line value in social enterprise. A social enterprise creates value not just economically but also socially and environmentally. This is known as the triple bottom line approach. Economically, socially, and environmentally, an enterprise has to create an impact. Triple, three. Financial value includes income generation, job creation, and economic empowerment, especially in underserved communities. Social value manifests through improved health, education, inclusion, or livelihoods, while environmental value is created through activities like reducing waste, conserving energy, or promoting sustainability. Together, these dimensions reflect a more holistic view of impact. However, monetizing this value, turning impact into income, can be complex. Understanding and monetizing triple bottom line value in a social enterprise. Opportunities exist in growing demand for ethical products, ESG aligned investments, and government incentives for sustainability initiatives. Social enterprises can also leverage their impact to attract impact investors, CSR partnerships, or premium customers willing to pay for purpose driven products. Yet, challenges persist. Social and environmental outcomes are often difficult to quantify and communicate in financial terms. Traditional markets may undervalue them, and many funding mechanisms prioritize short term financial returns over long term impact. Furthermore, the absence of clear impact metrics or third party validation can hinder credibility. To overcome these challenges, social entrepreneurs must build strong impact measurement frameworks, align their value proposition with market needs, and strategically communicate how their mission driven activities contribute to both society good and economic resilience. For social entrepreneurs, they need to understand the intentions of investors. Okay, what is the risk involved, return, and impact? So, for social entrepreneurs, our intentions of potential investors is crucial to building the right funding partnerships. Unlike traditional investors who prioritize financial returns, impact investors seek a balanced combination of risk, return, and social or environmental impact. Some may be willing to accept lower financial returns in exchange for high impact outcomes, while others might prioritize scalable models that promise both growth and measurable change. So people differ. It is essential for social entrepreneurs to assess the investor's risk appetite. Okay, how much the investor is willing to take the risk, whether they are open to early stage ventures or prefer proven models, as well as their return expectations, which can range from capital preservation to market rate returns. Equally important is the impact thesis of the investor. What kind of change do they want to support? How do they measure success and over what time frame? So, aligning enterprise's mission and growth strategy with the investor's expectations ensures a stronger, values driven relationship and increases the chances of long term collaboration and funding continuity. Investors differ in their priorities. Of course, some people they focus on financial returns, others on social or environmental impact or a combination of both. Impact investors seek a balance between risk, their comfort with early stage or high uncertainty ventures, return ranging from capital preservation to market rate returns, impact, the measurable social or environmental outcomes of the venture. Return expectations vary. Some may accept lower financial gains if the social value is high. Risk tolerance is key. Some investors back Innovative, unproven ideas, others prefer established models. Impact alignment matters. Investors often have specific causes or sectors. Example, education, health, environment they support. So time frame for results. You cannot take your own time. There is a time period. Investors may expect short-term outcomes or support long-term systemic change. Measurement is very, very critical. Investors want clear metrics to assess impact and progress. How many people they have gone up. Okay, something 20% they have received education, 50% they have received pure water, something quantification. Strategic fit ensures success. So, aligning your venture's goal with the investor's priorities builds trust and long term support. Transparent communication. Being clear about your social mission, risks, and growth plans fosters credibility. Strong alignment with strong partnerships gives. So, when values and expectations match, funding becomes more than financial, it becomes mission driven. So, what are the values and mission? Okay, alignment with investors' intentions. Shared purpose builds trust. Okay. So, aligning your social enterprise's mission with the investor's value fosters mutual respect and long term commitment. Investors are more likely to support ventures whose goals reflect their personal or institutional impact priorities. Reduces mission drift. Alignment helps maintain the core social vision, avoiding pressure to compromise values for financial gains. A common understanding of purpose makes discussions about strategy, challenges, and growth more productive. When both parties are mission driven, they are more likely to collaborate on solving challenges beyond funding. Increases chances of long term support. Aligned investors are more patient and may provide follow on funding, mentorship, and access to networks. Boosts credibility. An enterprise backed by mission aligned investors gains more trust from stakeholders, partners, and communities. Enables purposeful impact measurement. Both the entrepreneur and investor can agree on metrics that reflect real mission related outcomes. Avoids tensions arising from mismatched priorities. When growth is rooted in shared values, the venture can scale without losing its identity or purpose. So, concluding remarks. Establishing the capital needs of a social enterprise is a foundational step that directly influences its growth, sustainability, and impact. By accurately assessing startup operational and expansion requirements, entrepreneurs can strategically plan their financial journey. Understanding different funding types, that is, grants, equity, debt, or hybrid models, ensures the right fit based on venture stage and goals. Equally important is recognizing investor intentions around risk, return, and uh, impact, and ensuring strong alignment between the enterprise's mission and the funder's values. Ultimately, a thoughtful, mission driven approach to capital planning empowers social ventures to deliver meaningful change while remaining financially viable. Thank you.